So we start our three things that you got to know this morning with what we've seen over the past couple of days to put this morning's move in the futures in context, which it is very important to do. So let's take a look, first of all, at the Dow Jones Industrial Average, at the three-day chart of it and the 5.3% slump that we have had over that period of time. We've got the S&P 500 over the three-day period down about 7% here. And finally, the NASDAQ Composite down 10% in just the last 3 days alone. If you look over the past 3 days, and I've been zooming in on the NASDAQ 100, which is the index of the largest cap stocks within the NASDAQ 100, I've been zooming in on that. Over the past 3 days, only 5 out of 100 stocks in this index were higher over that period of time. 36 out of the 500 in the S&P 500 were higher over that period of time. And the S&P 500 having its biggest three-day slide going back to March of 2020. I've also been looking back, taking it back a little bit further here as well to look at what we have been seeing since the highs. So if you take a look, let's call it the 1 year chart, shall we, and take a look at what we have seen since the highs that we saw for the S&P 500. For the S&P, it made its high back on January 3rd. Since then, the index is down some 17%. So not quite in a quote unquote bear market. It's not 20% down from top to bottom, but it's getting close to that level, isn't it? And of course, if you're looking at something like the NASDAQ 100, it is in a bear market and then some. So in this case, we saw it make its high earlier. Let's see, right around here. That was November 19th. Since then, it is down some 26%, guys. So you're laughing at my drawing on the chart, Brad.
That is expert big board. Look, I mean, you don't even need me and Brad today. I mean, just stay up there, Julie, 2 hours and talk about bearish markets and chart formations. But let's stay on this route here because tech megacaps have shed more than $1 trillion in value over just 3 trading sessions since the Fed announced its rate hike last Wednesday. Apple, Microsoft, Tesla, Amazon, Alphabet, Nvidia, and Meta all lost billions in value over the past 3 trading days, with Apple the biggest loser at $225 billion. And guys, look at that chart here. You have the household name stocks that are owned by many institutions just continuing to get hammered. And I think that looking back now, that quarter from Netflix a couple months ago, about a month and a half ago, really was the tell that things were about to get ugly in the tech space. And what bothers me here now, you're not seeing the big name buyers. Where's a Bill Ackman coming out here with a big purchase on a tech stock? He was a seller of Netflix. He exited completely, which to me continues to be a red flag.
Yeah, I think coming back to Netflix, of course, when we think about the churn that took place there, it's not just the deceleration in growth, it's the churn. And for these high growth internet names, where that continues to remove some of the luster for getting into those stocks. And quite frankly, to the other side, it's led to this heavy selling and also kind of compounded with this rising rate environment, too, that's certainly hit tech stocks hard. And so I think going forward from here, when we hear from some of these companies increasingly on and over the course of the earnings season, but even around some of the results that we've seen and forecasts that we've seen thus far, there's not really a reprieve to be seen in this immediate near term.
You know, there are buyers in this market. They're just buying at lower
I can't
prices.
see them. I can't find them. If
No.
you're buying tech, please send us a tweet.
People are buying. They're just buying at lower prices. You know, I come back to my word of the year, re-rating. That is what we are seeing. You know, these companies are not going away, right? No. Meta, Apple, Amazon, Microsoft, Alphabet. These companies all have very sound and valid business models. But what are they worth? And obviously they're worth, in investors' minds, they are worth much less than they were. And I also feel like the recession talk has just ratcheted up and ratcheted up and ratcheted up to the point where clearly it is invading public consciousness. Already, I feel like inflation was on their minds. Now, with all the recession talk, that's on people's minds as well. I'll tell you one of the people who's buying now, Marko Kolanovic over at JP Morgan. He is a very, very highly watched strategist. He's been bullish, and apparently he is sticking to his bullish stance. He says he remains constructive on equities. Fears over an economic recession are unjustified, as reflected in certain parts of the market. So there are buyers.
You know what terrifies me? If you look at Netflix, down, 70% year to date or so, has it priced in a recession yet? Because is it going to get cut in half again? It's unclear. I mean, what if we do get a recession in this country? Do you now see Netflix trading at a single-digit price to earnings multiple? Well, it's about a market multiple now.
But isn't that already happening? In other words, we know markets are a discounting mechanism with a lag. So is Netflix maybe pricing in a recession now, or is it just only pricing in a dramatic remaking of its business, or a dramatic remaking in investors' minds of the growth prospects of the business? In other words, are we already pricing in a recession for some of these companies? I don't know the answer to that.
Yeah.
It's not like when we get 2 quarters of economic contraction, then stocks fall. They fall before it happens, typically, right?
Right. And when the business model shows like a glaring red flag warning as well,
Right.
especially in the case of Netflix here too.